Welcome back. Today we learn about the balance sheet structure. To understand the patrimony, the financial snapshot that reveal what the company owns, owes, and is truly worth at the specific point in time. What is balance sheet? Let's take a definition. The balance sheet is a financial statement that presents a given that all of company's assets, what is owned, and its liabilities, what is owed. What is the fundamental formula? Asset must equal to liability plus equity. The three pillars of the balance sheets, like you see in the graph, PR, assets, a liability, and equity. You must understand the balance sheet must have an asset equal to liabilities plus equity. When and why use the balance sheet? In the internal management, in the external investors, in the bank and the lenders, in the tax authorities. We given for example in this graph. When use it, take a moment to analyze it in the years and closing before seeking financing during business valuation, quarterly reviews. The balance sheet is a snapshot in time, not a video. It reflects the company's position on a specific date. Let's take a theoretical example, the math behind it. Let's build a simple balance sheet for a small business, Alpha Service. This is his assets, cash, account receivable, equipment, and his total asset is 45,000 euro. On the other side, let's take a look the liabilities and the equities, the bank loan, the supplier debts, the share capital, the retained earning. The total of liability plus equity is 45,000 euros. After verified, we see total asset is equal total liabilities plus equity. So the balance sheet is correct. This is visualizing the balance asset with liabilities plus equities. This is a graph. We show the graph show the cash, the equipment, the bank loan, the supplier debt, the equity, and let's reading the charts. The charts show that asset, cash, plus receivable, plus equipment, exactly match liability plus equity, loan plus debt plus capital plus earning. The visual confirms the fundamental accounting equation. hold true for alpha service. Any discrepancy signal an accounting error that must be corrected before closing books. Let's take a real-life example. The local bakery. Meet Marie, who opened Le Petit Four Bakery. Here is her balance sheet after 1 year. What she wants is assets. What she owes liabilities and her equities. After check, we see the asset is equal of a liability plus equity. That means the balance sheet of the local bakery is correct. Key financial ratios from the balance sheet. What the ratios tell us? Debt ratios equal total debt divided by total assets. Current ratios equal current assets divided by current liabilities. This is some graph. Expert advice: how to get the most outfits of it. Compare over times. Benchmark against your industry. Focus on equity growth. Use it for decision making. This is a key takeaway for memorize our lesson today. What is the definition? Asset must equal liability plus equity. When we use it, this is used by the manager, the investor, the bank, and the tax authorities to assess financial health. The example. In our course, we see the Alpha service and Mary Bakery prove the formula works in theory and in real life. What is the expert tips? Compare over time, benchmark your industry, and track equity growth for smart decisions. Remember, the balance sheet is not just a compliance document. It is a strategic tool for anyone who wants to understand the true value of a business. That's it for today. Thank you everyone. And if you have a question, don't hesitate to write in the comment and click the bell to get the notification. See you soon.